Welcome to this conversation on Business Redefined. As always, your weekly, most comprehensive look at developments in the world of investments, economics, and finance. And tonight, we want to take a look at the latest numbers released by the National Bureau of Statistics covering matters economic growth as well as balance of payments. We are delighted to have Churchill Ogutu from IC Group, where he serves as an economist covering East and West Africa, right?
Yes.
Glad to have you on set, Churchill. Karibu sana.
Asante sana. Happy New Year.
Happy New Year to you, brother. So, Churchill, when you look at the latest numbers released by KNBS, Q3 data, just to run through it, Q1 growth for 2022 was at 6.8%, Q2 5.2%, Q3 went further down to 4.7%. And the question here is, how do we begin to distinguish between the tapering off of the base effects from COVID-19, because we had seen a very strong rebound in 2021, and the fact that last year had a number of shocks coming back to back? Russia, Ukraine, we had the election. Where exactly do we draw the dividing line?
Thanks, Julian. I'll see it from a perspective of year-to-year comparison. If you look at it from a quarter-to-quarter comparison, that's where you can see that there's a declining trend. If you compare Q1, Q2, and the latest print that you've had for Q3. But then again, as you mentioned, there's a number of some distortion in the numbers that you saw last year. Basically within the base effects, COVID-19 playing a major impact, more so in the Q2 numbers and Q3 numbers for 2021. And because of those outsized numbers that we saw in those periods, definitely we could have seen a lower print in the Q2 numbers and also lately the Q3 numbers that you saw for last year. So there's that kind of some distortions in the figures, but basically distortion in the way that it's not a negative connotation, but because of that COVID-19 effect. The other thing that stands out, if you look at it comprehensively, we can't the effect of the downtrend in agricultural sector cannot be gainsaid. Yeah. Looking at a sector which is around 20% of the contributing 20% to the overall GDP, it has had a slowed growth over the last 3 quarters.
Contracted, actually.
Contracted, yeah, contracted, yeah. Over the first 3 quarters in 2022. So that one has a negative impact even in the growth numbers that you saw specifically for Q3. And to be sure, if you strip out the agricultural component, you find that the non-agricultural GDP posted a print of 5.7% in Q3 numbers. So we can't, the slowdown in agriculture, basically the weather impact that was there last year, there was a drought effect which affected a number of places in Kenya, played a major part in slowing down, leading to the contraction in the agricultural sector last year. Okay,
and maybe even before I get deeper into the subject of agriculture, just to walk you back to October last year when IMF was releasing their second Sub-Saharan African Regional Economic Outlook, they downgraded Kenya's economic growth projection for both 2022 and 2023. If you look at the 2022 projections, they were downgraded by 40 basis points, as from 5.7 to 5.3%. If you do the average of Q1, Q2, Q3, we're at about 5.6%. That tells you Q4, we're expecting further slowdown, right?
Yes, based on the numbers that we've seen from IMF. But if you look at it, IMF's numbers, this slowdown or the reduction in growth figures for 2022 is a comparison from the last Sub-Saharan African Economic Report, which was released in April. Remember, at that point, we still were groping in the dark to the extent the uncertainty of the Russia-Ukraine fallout and a number of other shocks that played out in the course of last year. So by the time now the print was coming out, the October report was coming out, already we had seen some of these negative spillovers filtering through into the economy. Inflation was on an uprise, and also some of the negative spillover effects of commodity price pressures in the economy. So Kenya, being a net importer nation and also not resourced in terms of commodities, was one of those names in sub-Saharan Africa that will have been negatively impacted by some downward reversions in the growth for last year. And so that 40 basis points reduction was not a surprise in the grand scheme of things.
Okay. And Churchill, part 2 of this conversation, by the way, will be delving more into those commodities and the balance of payments. But staying with the subject of growth, the question has emerged as to whether the slowdown we are seeing in the growth momentum is, in a sense, reflecting the transmission of the tightening we saw from the central bank as far as the monetary policy is concerned. Granted, inflation ramped up to levels we have not seen in about 6 or 7 years. Do you think that played a role in that?
To an extent, I will say that that played a role. Looking at how the MPC played out over the course of last year, we had the 75 basis points in the September MPC meeting. So that to me, and then we had another 50 basis points towards the back end of last year. That was around November MPC meeting. So the figures that we're seeing is between July to September period. And then MPC meeting was towards the very tail end of the quarter. So that might not have played an outsized factor in terms of the growth. But nonetheless, we had inflation pressure coming into the economy. Majorly between that particular third quarter period, average inflation was around 8.7%, which was higher than what was there if you compare third quarter of 2021. So that definitely had a negative impact, more so in some of the sectors. Also, it had a positive impact. If you look at the wholesale and retail sector, that had a growth of 9.1%. So that was one of the standouts in the 3Q numbers, wholesale and retail sector, but primarily driven by these inflation figures, because now as commodities prices, as some of the end prices, consumer prices went up higher, so that now filtered through even the numbers that we're seeing in the third quarter period. So that is now the positive spin to inflation numbers.
And just for the sake of our viewers, when Churchill talks about 50 basis points, that's half a percentage point. 75 basis points is 3/4 of a percentage point, basically 1% being 100 basis points. Thanks for that, Churchill. Still on the subject of monetary policy, if you look at the conduct of the central bank last year, we saw tightening. Then in July, there was a hold. Then when we came back, I think it was in November, or there was a significant September.
Yeah.
There was a significant step up in the tightening. And some have argued, what was the rationale behind the July pause? Because then you almost inflicted a shock in the system. How did you assess that move, Chacha?
I think that July move was something like, let's just hold up and see what the transmission of the previous MPC decision, that was the May MPC decision. So by that time, inflation numbers, we hadn't seen the numbers. We had seen the May numbers, we had the June numbers, we still hadn't seen the July numbers. But to me, that was just typical, if I may put it, default setting by our current MPC policymakers. And by that time, by the time we were getting into the July MPC meetings, we did some analysis against other African monetary policymakers. Whereas Kenya, we are just at a minute, or at 50 basis points increase, or a 0.5% increase in the policy rate, which was effected in May. Other African central banks had done 100 basis points. A full percentage increase on their MPC numbers, and that was driven by the inflation numbers in some of these regions. So to us, Kenya was still crawling, whereas other African policymakers, their inflation in their economies was really sprinting at a faster pace. So to us, just that July number was a standout, as they saw how inflation filtered through into the economy, or how it will be affected. But rather than declining, it accelerated further, and that now necessitated a 75 basis points increase in September and another 0.5% increase that you saw towards the tail end of last year.
Okay, we have 4 minutes to take a break. Let's talk about the subject of agriculture. Actually, if you look at the numbers, it is 4 consecutive months, or 4 consecutive quarters of a contraction in the agriculture sector. There have been adverse effects from the weather and climatic conditions. We've seen a bit of intervention now coming from the new administration, from a fertilizer subsidy and the likes. Are you optimistic looking at Q4 and into 2023 as far as the agri sector is concerned?
I'm still not optimistic that there could be that recovery. We've seen the efforts by the new administration coming in. I remember the previous form of subsidy by the previous regime was towards subsidizing consumption, but here we are at a situation whereby the new administration is now subsidizing production, and that's just a facet of it. If I may take you back to the economic survey for last year, and if you may have like a drill down into some of the agricultural input, on the material input, fertilizers around 30%, and that's followed by fuel and power, and then we have also chemical, food chemicals, and also manufactured seeds in that order. So 30% of the production, that is where it's getting subsidy. But remember, we are at a situation whereby we are getting into fuel and power, getting being on an increase. There's some transport costs that will also be a part of the input into this agricultural sector. So I'm not quite optimistic of the same. And that's just looking at the crop section. But if you may focus even on the livestock and other products, which is now within the livestock ecosystem, with the adverse weather condition, 4Q numbers will not be that impressive as what you've seen. So we could see either a contraction in the agricultural print for 4Q period, spilling over into the first quarter of this year.
All right. And that point by Churchill takes us to a short break. We shall be right back with a lot more now, focusing on the numbers around balance of payments. Stay with us.
You're going to take your oxtail and then you're going to brown it.
Enjoy thrilling new drama series.
You've never been good.
The Long Ballad. Love and Pride. An Identical Twins and Q.
Alisha alikuwa mke mzuri na mwenye furaha, lakini rafiki yake wa karibu aliporudi kutoka ng'ambo, hapo ndipo kila kitu kilibadilika.
Ashajua ukweli. Njoo mwambie roho yako imepata makao mapya.
Tazama Q kwenye Rembo TV.
Unaenda wapi?
Leave me alone.
Recharge and get upgraded.
Star Times. Enjoy digital life.
Welcome back to this conversation on Business Redefined, where we are joined by Churchill Ogutu from IC Group, where he's an economist focusing on the East and West Africa. We are talking about the latest numbers we saw from KNBS, that is economic growth as well as balance of payments. And the balance of payments now is the subject of the second part of this conversation. Churchill, welcome back on set.
Thank you.
First, when you talk about BOP in the last numbers we saw, last year was a very interesting year as far as foreign exchange markets are concerned. We saw the Kenya shilling and other frontier market currencies being roiled significantly by the dollar. When you looked at the numbers on the BOP side, did you actually see this being reflected? I saw the import bill on petroleum products, for instance, was quite significant.
Yeah, that was reflected if you look at the BOP numbers, balance of payments numbers, and the fact that in as much as exports rebounded last year, it was around 29% to 30%. Imports also, that was from a lower base on the export side, but imports just grew by around 22%, but now we are looking at around 600 billion. So that impact of more so on the two commodities, we are looking at the fuel. Last year there was a comparison that even the balance of payment did, that it was a doubling, the average that was there in the course of the third quarter last year vis-a-vis the third quarter of 2021. So there's a doubling in the global oil prices, and that definitely had a negative impact even in the overall balance of payments that we saw. The other thing, if you look at around effects, more so in the Kenyan context, there's one number that probably we haven't really focused on, and that's on the net foreign assets. In the banking sector, this number was around 272 billion. That's the aggregate net foreign assets with the banking sector, and that we're looking at the Central Bank of Kenya, we're looking at commercial banks, we're looking at microfinance banks, and also some of the deposit-taking circles. But if you do a drill down, you find that the net foreign assets for CBK was around 580 billion shillings. But if you look at the net foreign for banking sector, net foreign assets for banking, commercial banks, that was around 290 billion. So that's where the 292 billion net is coming from. Negative for commercial banks, that was on a negative, but for central bank was a positive 580 billion. So that is a concern. That is a big concern, because if net foreign assets for banks is at negative 280 billion, and this is a record low for banks, and that now points to what we've been seeing, what we call something like a parallel market, or things like official rate being at right now, we are talking about 124 shillings, but whereas from the banks it's 130 shillings. That's something that is a big concern, looking at the 3Q numbers, getting into 4Q numbers, and also right now. If it's not addressed, we'll be looking, and that's something that played out. I'm also covering Egyptian economy, and that's something that started playing out and now led to some of the devaluations that played out last year. So if you're circling back to FX and how it played out, last year I think overall Kenya shillings depreciated by around 8.5%, and that's basically because of the weakness and net foreign assets, and also the impact of ballooning import bill that was there in the course of last year.
And Churchill, to stay on that subject and really now to bring it to a manner in which majority of us can relate to, there's been a conversation, and this was even flagged by the International Monetary Fund in their latest report, which was the 4th review of the Kenya program, about the state of Kenya's interbank foreign exchange market and the fact that it hasn't been functioning optimally. When you look into 2023, and we are seeing a bit of easing as far as commodity prices are moving globally, do you see us making a step in the right direction as far as this is concerned?
The thing about now the interbank FX market, that's talking about operational issues. So we haven't seen anything coming out from that segment to show us that at least there'll be some transparency in terms of how interbank's FX market is. And just to give you a classical example, looking at some of our peer countries, if you look at Ugandan data, they give us like an overview of interbank's FX market in terms of dollar purchases, dollar sales. That's on a monthly basis. But if you look at the Kenyan market, there's an issue around transparency. So if this issue about transparency is now addressed, we could now see some vibrancy within the interbank FX market. I haven't seen what kind of proposals the IMF put to the authorities in regards to that issue. But if that comes to the front line, I think that will address some of the issues that we're seeing within the interbank FX market.
Okay. And one of the bright spots I saw in the balance of payment numbers is that in the last quarter, that is Q3 of 2022, that's the period between running until September, July to September, I should say, is that our net trade with the East African region seemed to be improving. You know, for a long time we have been on the back foot, we're losing traction. But if you look at those numbers, is it a pointer that we could finally be getting our position right, regaining our foothold as far as East Africa is concerned?
I think that could be a one-off thing, because I know there were some exports that we did with Uganda, majorly within that third quarter period, which ballooned even, which now filtered through into the overall export numbers. But I think to an extent that was a one-off. It was something to do with even with exports around palm oil, which was even stand that we can have some re-exports of palm oil to Uganda. So
considering the shortage we had in the market.
exactly, yeah. So to me, that's just a one-off. We could see, even if it spills over into the fourth quarter, we could say, hey, here, at least there's some trend that is starting to form, and to reverse what you've been seeing in the last 3 quarters prior to the numbers that we've seen, whereby now East Africa has been, the reverse has been towards East African countries rather than coming in inroads. So I'm just waiting to see the 4Q numbers just to have a clear trend as to whether it was a one-off or here there's a clear trend starting to form.
And also that point of being a one-off, it's also worth noting that the Q3 numbers are the first set of numbers which reflect the addition of DRC into the East African bloc, and therefore that plays out as far as Kenya's position is concerned. So Churchill, looking ahead, there's been so much conversation about 2023 being most likely a recession year globally, and the question is emerging, what can Kenyans, and the ordinary Kenyan for that matter, expect as far as that hitting our pockets is concerned?
Yeah, definitely there could be some negative spillover effects. Remember that Kenya is a net importer nation. So as the global economy gets into a recession, it will disrupt some of the global supply chains that Kenya relies on, being a net importer nation. Also, the other thing is that we are a commodity reliant nation. We rely on other countries in terms of some of the commodities as part of our intermediate goods and services, so that will also be affected in the amidst the discussions around global recession. The silver lining around that is we could see some policy easing within the monetary policy space just to absorb that shock of recession. Right now we are at around 8.25%, in as much as inflation is on a back pedal. Looking at the last numbers, that is in November and December, at least those are some form of disinflationary trend starting to form. But that said, we could see at least monetary policy coming in. But I think once there's a clear trend of global recession coming in, they may come in and more or less act as a backstop towards to cushion the economy in terms of that. So that will be a positive spin in that conversation. So
let me just hold you there, Churchill, and just for the sake of our viewers, so disinflation means now inflation is beginning to reverse. We have seen it rising very fast. We are still seeing it high, but now at a much better, if I could say, rate, coming from 9.5 to 9.1, moving further downwards. Intermediate goods are goods used in the further production process. So you import them, but you're still using them to process other goods. And monetary policy easing is the central bank now beginning to cut its benchmark rate. So let me just remind Churchill, this is mass media. So Churchill, a lot of Kenyans are having this conversation. We have seen the headwinds that Ghana has run into as far as debt is concerned. Overall speaking, what's your assessment of the Kenyan position? We've had a conversation around liability management by the National Treasury. We saw a switch bond auction inviting investors to swap their short-term instruments for longer-term instruments.
By and large, I think Ghana is giving us a template to any African that might be in a debt distress situation. But if you compare Kenya and Ghana, just to be fair, we may not be as Ghana was, say, 2 years ago or 1 year ago. Kenya, at least, we are not there. We are heading there, but you're not yet there as Ghana was. So at least this 18 months will be a determining factor. Remember, we have a Eurobond maturing next year in June 2024. And that speaks to the liability management operation. I'm sure that this is giving Treasury people some sleepless nights on how they'll be able to go about it. Yields have not been coming off, have not been coming down
in the international market.
In the international markets. Yeah. And that should give them some form of comfort. As we started last year, yields on the 2024 paper, that one was around 4%. At some point, it peaked at 21%. It has eased to around 11%, but still, that's still double-digit level. So from Treasury's perspective, I know this is not a strategy, but they probably might be hoping that yields come lower than that. Yeah. So that probably is one. But I think that they might want to do form of reducing that outsized $2 billion that is expected to mature next year. At least if they may come up with a coherent strategy around that, trying to reduce it to probably $500 million, that will give them some fiscal space. I think that is something that they may be trying to think about, and that's something has been played around African markets. There have been previously, before these headwinds that came last year, a number of countries did liability management operations. None other than even Ghana, they're part of that. So it's not that Ghana didn't do anything, it's only that there's a number of fiscal indiscipline that now caught up with them, and necessitated the restructuring that we saw. For the Kenyan market, in terms of domestic debt, I think that's a right route to go. What you saw in November, December, playing out whereby they restructured the three treasury bills and also one treasury bond, which actually matured last year. Yesterday, they were to mature yesterday, and we did a bit of some liability operations. They would have been faced with 87 billion, but at least they reduced it lower by that liability management operation. Yeah. So probably that provides them some template. We could see a few other bond switch auctions within the domestic debt market, and that's one of the proposals that was placed when Kenya entered third and fourth DPO with the World Bank. Those are some of the strategies that the authorities presented to the World Bank.
All right, Churchill, unfortunately, we've run out of time and we have to close it at that. By the way, a DPO is a development policy operation. This is a loan facility which comes from the World Bank to member states at fairly concessionary rates. That is what we call soft loans in terms of the interest rate. We shall continue highlighting these issues in subsequent episodes of Business Redefined, so stay tuned to NTV. Thanks so much for viewing tonight. Stay tuned.